It is Saturday morning, November the 10th, and I'll be reviewing some charts of the stock market this morning. I'll give you my take on the technical analysis, technical picture of what's going on here, as well as some chart patterns and where I think we're headed over the short term and intermediate to longer term. And I'm going to start this morning and actually go from shorter time frame to longer time frame here. And this is a chart of SPY, the S&P 500 ETF, and what we can see on this chart, we have a MACD indicator down here, and there's an ADX indicator. The ADX indicator, as of the end of this week, was up near close to 40, which on a textbook level, that's a pretty extended trend. So on an hourly time frame, we may see this directional type of movement start to consolidate a bit here early into next week. Now the MACD is also oversold, and you can see that when we've seen those oversold conditions here over the last several months, we've seen rallies in the market. Now I would say at this point in time, given the longer term context, the market may be in a relatively weak position. We might not get a major rally attempt here, but certainly the stage is set, at least on a short-term basis, for a multi-day rebound attempt in the markets. Now, as far as confirming the downward price action in the market did not really confirm a new downward trend until at a minimum this point here, and we saw that this move down was faster and larger than this last little move up here, and likewise off of these highs up here, particularly off of this high here, this move down was quite sharp, and this move here did not retrace 61.8% or more of this prior move, so that indicates that we may be seeing a new move start at this pattern rather than a continued overlapping type of corrective pattern. In any case, I believe that we might have started a new downward pattern either from the October 18th high or from the high right here on the day after the election on November or this was the day of the election, November 6th here. So we may have quite a bit more downside in store here for stocks. Now on a daily time frame, if you click over to this is a daily chart of SPY, we can see that the Bollinger Bands are in a volatile configuration, in that the lower band is expanding and the upper band is expanding as prices are hugging one of the bands, so in this case the lower band, and that implies potentially increasing volatility until price makes a turn back to the upside. Now on the flip side of that, since the market has been hugging the lower band, statistically, most price action is contained inside those bands. So we're going to see probably one of two things. We're probably going to either see the market undergo a sharp and dramatic sell-off that lasts a brief time, possibly even a large gap down that takes a huge price chunk of price movement in a very short period of time in the overnight session, or we'll probably see this thing start to stabilize, the bands start to stabilize, and then possibly consolidate or rally a bit here. So I think next week we'll probably early next week, I think we may see some more downside as the market tried to move up and close high here on Friday. It was then taken back down and closed actually in the lower third of its range there. So still some weakness, still some selling coming in towards the end of the day. So we may see a weak open to next week, and if that happens and we push below Friday's low, that opens up the potential for an even more vertical type of price decline. There are a couple gaps yet to be filled here on SPY that we could look for initial support, and there's a gap down here right out from June 6th as well. That would be another gap level, and I think ultimately my personal expectation may be that this move stays rather aggressive to the downside until we take out the June low, at which point we may see an initial rally attempt, though I don't think it's going to be one that takes us to new bull market highs. But that's a lot yet to be seen, but that's what I think we can gather from the daily chart. This is a RSI study down here. This is momentum. That you could interpret them both about the same way, but they're nearly oversold. The RSI is nearly oversold, but there's no divergence yet, no bullish divergence. At the end of most substantial corrections, you will see at least some mild divergence, like we saw back here between the May trough in the RSI, and then we saw a higher bottom in the RSI as price went lower. That's a very classic divergence there. We did see last year in August, we saw this dramatic move down into the August low with a real spike low in the RSI, and it put in a nice, tradable rally attempt there, and then as price pushed back to new lows below that August low, the RSI made a much higher bottom. So those are the type of things we're looking for at the end of a multi-month correction here, at least on the daily time frame, to see some divergence starting to develop. The momentum indicator tends to be a little bit more sensitive, and even that is not showing any divergence. It's actually gone to lower lows for this correction as of the end of this week. So I think we should at least see that momentum indicators start to make some divergence as price makes lower lows. So I would say my interpretation of those would be that we at least have it several days more of downside or a brief rally attempt followed by a lower low to create some divergence there. Now I'm going to show a little bit of higher time frame charts here. This is the S&P 500. This is a weekly chart with a stochastics indicator, and we can see the stochastics indicator is pointed down here, and it's at approximately the 50 level. So until this actually gets down closer to the oversold level, I would say that we should consider the momentum be down, and for tradable moves you want to be looking at the hourly stochastics, so an hourly chart, to actually get overbought and then move and then turn into a sell type of configuration, and that would put you in alignment with a larger current there. So that's what to look for there. Not quite oversold yet. Now, this is a weekly chart of the S&P 500 with a MACD study here, and we've seen this classic bearish divergence in the MACD right here between the 2012 highs and in April and in September there. And now the MACD has crossed into a bearish cross and has opened up nicely here, and it's broken this base trend line here from October to June lows. So that, given the fact that the MACD is overbought and there's bearish divergence from overbought, this could have a substantial correction. The last time we've seen that, we saw 15 to 20% corrections in the market. We're only down maybe about 8% or so right now. So we could have quite a bit of downside left before these weekly charts start to show any type of legitimate oversold condition. We even have several weeks before the MACD would approach the zero line, which it may find a support type of level in a bull market as it approaches the zero line. Now moving to a monthly chart, this is a chart I've showed frequently over the last several months, and this is the S&P 500, and this has a stochastic study down here. And what we've seen is that the stochastics has been overbought for basically most of 2012 here, and what is showing up now is a significant bearish divergence in that stochastics indicator, and we've seen some overbought stochastics there in 2010, 2011, 2012, but what we've seen now is between the last couple swing highs on the monthly chart here in September and then in April there, that we've seen actually lower peaks in the stochastics, and now the stochastics is actually crossing down here. So we'll have to wait till the end of November to confirm this, because that the month is not complete yet. But assuming we end November lower than we end October, that would be a pretty nice stochastics sell signal coming with divergence from overbought condition on the S&P 500 here, and that's a pretty long-term signal. That's the type of signal we saw here at the end of the 2002 to 2007 bull market, in between here and the final couple peaks there. And we also saw a similar signal between the peak at the 2000 bull market, between the 2000 highs in March and in September there. So that's something to be aware of longer term, that we may have not only several more weeks of correction, but we may be entering a legitimate bear market type of period where we see several months of downside and implied large price correction here. Now, moving to a quarterly chart, and I've showed this a few times, this is the the Dow with the quarterly chart with stochastics, and we can see that the stochastics is overbought, which doesn't necessarily mean a whole lot in and of itself. You can see it was overbought more or less from 1990 all the way to 2000, so that's not very significant. But these red circles here show times that it was overbought actually at a lower high. So these other times here, it basically got overbought at a higher high than the previous signal, and the market continued to move up, whereas this time here in 1937 we saw, after the big Great Depression type of bust, the market put in a nice rally. It was overbought, and we saw sideways action for about 5 years. And then in the 1970s, after the 1973 bull market high and late 74 bear market low, we saw it push up, get overbought at just a slightly lower high, and then the market consolidated again for several years. So we're in a similar position here, where we underwent a historically large bear market. The market has rallied up close to those highs there. We're now overbought, and if you look at the stochastics close up, it is starting to cross down, but we'll have to wait till the end of the year for the quarter to complete to see if it stays in that configuration there. But if that does happen there, we do have some indication that on a long-term basis we may be seeing one of these drawn out multi-year consolidation type of phases in the market. So my overall take on the market here is that the larger currents are turning down. So we have monthly that is divergent and starting to turn down. Weekly is already down and not overbought. The daily chart is relatively overbought, so we may see one of two things, which is we'll see a rebound attempt very quickly, or we're going to see a panic type of sell-off where the price declines probably get successively larger, and we may see a puke type of session where we just see a tremendous price decline in a couple of day period there. So that would be what to look for over the near term here. Now I'm going to open a chart of some of the put-call ratios here, and I'll just show you briefly where the sentiment is. The sentiment is to some extent stretched to the downside, but not extraordinarily so. This chart here shows the the total put-call ratio, and this is the ratio of the 5-day average to the 63-day average. This green line would show when that shorter term average is high relative to the long term average, and that would be a time where you're starting to see a get out of balance in the sentiment as indicated by the put call ratios. This is one of the simplest, most accurate sentiment indicators that I know of. I don't know that you need a whole lot of more sentiment analysis than the put-call ratios to successfully understand when the market's going to turn. And what we've seen here is that once this starts to go above that green line over the last couple years has been when the market has been stretched to the downside and is ready to rebound. However, the ultimate price lows have occurred after the peak in the put-call ratio. So if you saw here, around May 18th was the peak of that ratio, and the market did put in a few-day rally, and then prices actually moved to a lower low as this put-call ratio moved to a lower high. We saw a similar thing there between August and October. We saw it to a minor degree in June of 2011. In March of 2011, we saw more of a spike low in prices there, but that was in the context of a continuing bull market too, whereas right here we may be shifting to a more of a bear market configuration. So what I would look for here is look for first off for sentiment to probably get stretched more to the downside, then a rebound attempt, and then a new price low followed by a lower high in the put call ratio measures there. So that's what I would use for sentiment over the intermediate term, to look for an intermediate term bottom there. One last chart I'll show here is just the pattern large scale pattern we're looking at in the stock market, and I've talked about this several times in recent posts. We're seeing a large rising wedge type of a pattern happen, which would imply some pretty large scale declines here. So if we look at the S&P 500, what this is showing is over from the 2011 to the 2012 highs, we have this upper boundary between those highs. we have a spike above the highs or a throw over above the upper trend line there, and then between the October 2011 low and June 2012 low, we had this rising trend line. And what I noted here recently is that the market had sorry about that. I had a PDF that crashed my browser there. So between the October 2011 low and the June 2012 low, this rising trend line has now been broken. And what I mentioned recently is that we saw this touch of the S&P 500 to the trend line. We saw a brief rally attempt, and I said that if we break that low there, that may open up the floodgates on the selling. Then we saw the election, and we did see this big sell-off here. And what I think we may have is a completed and confirmed ending diagonal type of chart pattern, and that would imply a move down to the at a minimum to the October 2011 low, and that will typically happen in roughly around a third of the time that the wedge takes to form. So if we say that this move here from October 2011 to October 2012 took a year, we may see a move down to the the 1100 or 1000 level by the spring of 2013. So that would be obviously some dramatic downside here. I'm not necessarily making a prediction on that, but from a chart pattern, that would be, as hard as it is to believe, that would be a relatively standard type of price action there. One more interesting thing on this chart is we're now touching the 200-day moving average here on the S&P 500. I've talked about these type of setups in the past, but what we may see here is as price initially touches the 200-day moving average, we may see a brief rebound attempt. But once you have a swing low after it touches the moving average, kind of like we saw down here, the best rebounds will not then come below that swing low. So if you look at the June 2012 low, we saw the market come down, break the 200-day moving average, form a swing low, come close back above it, and then it was off to the races from there. So if we see a rebound attempt from here and then a break back to new lows or below that swing low, oftentimes you'll see selling continue to accelerate. So if we do see a rebound attempt here early this week, that's something we want to gauge. And from a trading standpoint, if you do see a brief rally there, you could actually then put orders to short on a stop back below that swing low, and that would give you a way to say, hey, if the order doesn't get filled, I'm not going to be short, but if the market does come down below there, I could enter short with a relatively tight stop above whatever rebound occurs there. And that way you're kind of trend following the market in that case. So that's my take on the markets here for the upcoming few weeks to few months here. I think overall we're going to see some pretty aggressive downside, possibly with some short-term rebound here over the near term given the oversold nature. So that's all for this update. Have a great weekend.